Good afternoon, ladies and gentlemen. Welcome back to this 1st of July weekly market review, and we have officially started the second half of 2024. Today, I have with me Mr. Gerald Wong, who is here to share with us some of the market updates. How are you, Gerald?
Very well. So at the blink of an eye, the first half of the year is over. For those of us who have been looking forward to what is upcoming in the market at the start of the year, seems like it has not really panned out in terms of the interest rate cuts. So we can do a review around what has happened in the first half and what are the key things to look out in the second half of this year.
Yes, and last Friday, we do have that important PCE data, which was largely in line, so that removes some of the fears that inflation might be coming back, and that means that the monetary policy is taking its effect now to gradually bring down inflation. And Joe, you will share with us, do a summary of what happened in the first half of this year and give us some updates on the market as well.
Yep. So as usual, today's sharing is for information purposes only. It should not be taken to be financial advice. We have an upcoming Ask SIAS on the 17th of July. This is exclusive for members of SIAS. So if you'd like to join us, do scan this QR code to register by the 15th of July. If you find the weekly market review helpful, do leave us a review on Google. And if you are thinking how you can join SIAS as a member, you can scan this QR code or go to this website. The membership for SIAS will cost $12 per year or just $1 per month. Okay, so we do a summary of what happened in the past week. We saw that the S&P 500 was little changed, just down about 0.1%, as there were no major economic data points or earnings that came out. So investors effectively are still awaiting what will be coming up in the second half of this year. But what actually surprised me was that the STI has done very well last week, up by 0.8%, now at a level that is close to its year-to-date high. So we can discuss what is driving this strong performance of the STI as well. Okay, so in summary, we have seen that the US stocks did very well in the first half of the year. The S&P 500 was up by more than 14%, just in the first half alone. What we see is that this is led by the tech stocks, with the Nasdaq up by 18%. Okay, the Dow Jones didn't do as well, but still up by 3.8%. But as we can see here, a lot of the gains are actually led by the tech stocks. Okay, what is actually driving this rally? First and foremost, we see that the US economy has been more resilient than expected. Whether we look at retail sales or the job market, both of them have actually been very strong, which actually indicates that previous fears of a recession is actually unfounded. Next, we have this boom in artificial intelligence, or AI, which led to a rally in stocks related to the theme. So stocks like Nvidia, as well as your other chip companies, actually driving a lot of the gains that we saw in the Nasdaq. Last but not least, we are still hopeful of potential rate cuts. As what Sunny shared at the start of the call, we see that inflation has continued to ease in the first half of the year. So that is leading to expectations that the Fed will still eventually cut interest rates. Okay, so this is what we see in terms of the current expectations on interest rates. Okay, at this point in time, we have not seen any rate cuts coming through as yet. But based on the market expectations, there is a high probability that the first rate cut might come through in September, and then followed by potentially another one in December this year. Okay, so that will bring the total number of rate cuts in 2024 to potentially 2 rate cuts, with a total cut of 0.5% or 50 basis points. Okay, so moving to the Singapore market, we saw that the STI actually outperformed the S&P 500 last week. If you look at the top performers, there were a few stocks that have done particularly well. ST Engineering up by 7.2%. We can go into a bit more detail to discuss what is driving the strong performance of STE later. Singtel up by another 4.2%. Also another stock that has breached its 52-week high. We have discussed Singtel in the previous weekly market review. So if you want to do a recap around what is driving the strong performance of Singtel, you can catch the previous weekly market review. Okay, outside of this, we also see some of the REITs starting to rebound slightly. So CICT leading the strong performance of some REITs, where we see CICT having a gain of 2.1%. Okay, we'll discuss further about CICT later as well. Okay, in terms of the worst performers, we see Citrum still actually moving downwards. Okay, so this is a stock that we have discussed previously. The share price has been very volatile, and we see that the weakness has continued into the past week. Part of this might be because of concerns around the overhang around the investigations that the company is involved in. But we will see how that actually pans out and how that will further impact sentiment towards Citrum. Outside of this, we see some of the Jardine-related names also facing some downward pressure. Jardine Cycle & Carriage down by 8% and Jardine Matheson down by 4.5%. Okay, so I'll start by discussing a bit about ST Engineering. This is one of the stock that has actually exceeded its 52-week high. Previously, it was range bound at about the $3.60 to $4 level. But here, what we see is that from the early part of May, there was a breakout in the share price to above $4. And now we are closing at $4.33 as of last Friday. Okay, so what is driving this strong performance of ST Engineering? Last week, they actually made an announcement of a new 120 million data center in Singapore, which will bring its total capacity to over 30 megawatts from 4 data centers. Okay, so we see that quite a number of firms that are now investing in data center assets. Singtel was one of the previous companies that we discussed that is also having significant investments in this area. So we see that because of the increased demand towards data centers, there are few companies that are actually capitalizing on this trend. Okay, so outside of this announcement that ST Engineering made last week, what we see is that the fundamentals of the company are actually improving. If we look at the first quarter earnings update, we see that the revenue of the group was actually up by 18% in the first quarter compared to the first quarter of the previous year. Okay, what is driving this increase in revenue? That is coming through from two key segments. One is commercial aerospace. So ST Engineering would actually be performing maintenance repair work for some of the commercial aircraft. And what we see here is that the revenue has actually grown as a result of this increased demand for maintenance and repair work. Okay, so the improvement in global air travel has actually translated to more servicing need for the aircraft. And ST Engineering is actually seeing increased revenue as a result of that. Okay, outside of that, we see that the defense and public security segment also saw a 14% increase in its revenue in the first quarter. And that is really a reflection of more contracts that they've been able to secure within this segment. Okay, what we have also seen for ST Engineering is a continued increase in its order book. Okay, so from 19.3 billion at the end of 2021, that has grown to 23 billion at the end of 2022 and 27.4 billion at the end of 2023. Okay, so we see this continued increase in its order book as a result of strong demand for some of its services, including some of the defense contracts that it has been able to get, which has helped to boost the order book of the company. Okay, so of this 27.4 billion of order book that it has as of December 2023, close to 8 billion is expected to be delivered in 2024. So as it recognizes this order book that it has, the revenue will actually pick up, just like what we saw in the first quarter of this year. Okay, so 27.4 billion order book at the end of December 2023. And if you were to look at the first quarter of this year, they have continued to win new contracts amounting to 3 billion. And with that, we see that the order book has continued to grow to 27.7 billion as at 31st March 2024. Okay, in terms of where the contracts are coming through from, more than half of them are coming through from defense and public security. We see that within the commercial aerospace segment, the orders have been picking up as well. So all of that is helping to drive the strong order momentum for ST Engineering, which is translating to more revenue visibility in the coming years. Okay, so if you were to look at ST Engineering, a lot of investors look at it from a dividend perspective. Okay, if you look at the dividends paid out for ST Engineering, it has been quite stable at about 15 cents from 2019 to 2021. So that has translated to a dividend yield in the range of 4.5 to about 5%. The company raised its dividend per share to 16 cents in 2022. That was what they paid out in 2023 as well. And based on current market forecasts, the dividend per share is expected to be 16 cents in 2024. Okay, so very stable dividend payout for ST Engineering. And based on the current share price, that will translate to a potential dividend yield of 3.7%. Okay, so the other thing I noticed about ST Engineering is that the payout ratio of the company has been fairly stable. So this will effectively measure how much of the earnings it is paying out in terms of dividend. And over the past 4 years, it has been in the range of 82 to 94%. So there is actually sufficient buffer based on the earnings for it to pay out and maintain its dividend per share. Okay, so I think that is why investors have confidence that they'll be able to maintain the 16 cents dividend per share, especially if they are able to continue growing their earnings. Okay, if I were to look at the dividend yield for ST Engineering now, I mentioned earlier, based on the current share price, if they maintain the 16 cents, that will translate to a dividend yield of about 3.7%. So this is at the bottom end of the historical average band that it has traded at, given that on average it has offered a dividend yield of about 4.6%. Okay, if you look at the valuation of ST Engineering now, from a price to book perspective, it is looking again at the higher end of the trading range, given that the stock has broken out of its 52-week high. Okay, so currently at about 5.5 times price to book. But if you look at the price to earnings ratio, given the expected growth in the earnings, it is still trading at fairly reasonable multiple compared to the historical average price to earnings ratio. Okay, so that is ST Engineering, one of the stock that has been of focus given that it has broken out of the 52-week high. I also wanted to discuss a bit about CICT, CapitaLand Integrated Commercial Trust. This is one of the most popular REITs within Singaporean investors. It has got assets that we are familiar with, both within the retail as well as office space. And if you look at the share price performance, it is one of the REITs that has held up relatively well year to date, given that we have seen quite a number of other REITs actually coming off, given that the interest rates have actually remained higher for longer. Okay, so what is driving this relative resilience in the share price of CICT? We saw that within the STI, it has been one of the top performers in the past week as well. So first and foremost, it has got fairly diversified assets within retail as well as office. So that actually buffers it against any particular decline in a subsector. So what we have seen is that these assets have actually done relatively well over the past 12 months, which have supported the distributions of CICT. Okay. The other thing that many investors like about CICT is that because the bulk of their assets are in Singapore, so that has actually mitigated some of the FX risk as well as depreciation of regional currencies, which has impacted the distributions of other REITs. Okay, so in terms of what we see for the distribution for CICT here, after the decline that we saw in 2020 as a result of COVID, it has actually recovered, okay, steadily in 2021, 2022, as well as 2023. So that has actually helped to support the dividend yield of CICT. Okay, at this point in time, CICT is offering a dividend yield of about 5.6%, just slightly above the historical average of 5.3%. So this might be something that has actually caught the eye of investors as well, in that while the dividends are actually starting to recover, the dividend yield that is offered by CICT is actually still above the historical average. Okay, if you look at the price to book of CICT now at about 0.9 times, which is in line with the historical average. Okay, so neither too high or too low compared to the historical average, and still trading below the 1 times price to book level. Okay, so I think generally for CICT is that what we see is a relatively stable REIT in terms of the assets that it holds, because of the diversification between retail as well as office, having the majority of the assets in Singapore, which has buffeted it against the weakness in regional currencies. And in terms of the valuation, dividend yield still above the historical average, while the price to book is actually in line with the historical average. Okay, in terms of what to look out for in the week ahead, new month, so we have the start of the SSB applications once again. We have a 6-month T-bill auction that's coming up on Thursday, and we start to go into the release of economic data in the US once again, starting with the non-farm payroll data coming up this Friday, the 5th of July. Okay, so with that, I'll hand over to Sunny, who will share the technical analysis.
Hey, thanks, Gerald, for that sharing. So I'll go through some of the updates or developments on the charts for the major indices. Let me start off with the Singapore Straits Times Index. Just a recap for the month of June, you can see that the volatility actually sort of came down compared to the month of May, so that the Bollinger Band actually narrowed. So during the month of June, you can see that we are mostly trading within this Bollinger Band area, which is quite much narrower than what we see in the May period. So that means that the volatility has come down during the period of June and not much of a movement over here. So the projection here, according to the Bollinger Band, is going forward in the next few weeks. The STI index might likely trend or trade in a range bound kind of direction, meaning a sideways direction. Thereby, the upper bound or the upper limit of the Bollinger Band will also be the key resistance level to watch out for, and that might coincide with the year-to-date high that we saw on the early part of June, which is the high of 3,355 points. So that is a key level to watch, and you may see a stronger pullback once we touch that level again. On the support side, the lower bound of the Bollinger Band is now at the 3,291 point level. That sort of found some confluence near the 50-day moving average as well, which is the blue line that you see here at 3,296 points. So I would say the range would be going forward would be trending from a 3,300 to 3,355 points level. So that is the level that we are looking at. Anything below this 3,300 level, which is what we identified since the middle part of June over here, this area over here would be the key support level that we are looking at right now, and a chance to get back on the STI index should it comes back down to this level. So just now, Gerald also touched on how the major US indices has performed in the first 6 months of this year. For the STI index, for the first 6 months, we are up about 3.6% or close to 4%. So that is the gains that we saw in the first 6 months for the Straits Times Index. So looking at the indicators right now, there is not much of a big movement. You can see that the MACD indicator is still pretty flat right now. The trajectory is horizontal. So although it's still a positive reading, that means there's a very slight positive momentum in the STI index right now, but not something that will cause a breakout above the Bollinger Band reading, which is at 3,355 points. On the RSI index, the latest reading is at 58, 8 points above the 50-point neutral mark. So that means it still has some positive momentum as well, but then also not in the region of the 60 to 70 point level, where it would have a stronger momentum to push for a breakout level. So I would say now, according to the indicators and some of the key levels that we are looking at right now on the Straits Times Index, likely STI index in the next few weeks is likely going to be range bound between the range of 3,300 and 3,355 points. Next, let's move to the Dow Jones Index or the US indices. So last week, we also had the first debate of the US presidential election race, which the performance of President Biden was a bit shaky. So there's not a lot of confidence right now going into the election in the second half of this year. But I don't think that it has a lot of impact on the indices yet or the stock market yet, although Donald Trump may be seen as a more friendly kind of a election candidate for the Wall Street market. So I think now the markets also compared to for the month of June, going into July, you can see that the Dow Jones Index volatility has also come down. Some of the highs that we saw somewhere in the middle part of May, where we reached a high of about 40,000 mark level, that has come back down to about 39,118 points from the middle of May period. So within this point, the next resistance level, of course, the key level we will be watching will be the 40,000 handle, which will be a very key resistance level to watch out for. And a lot of people would have been, there would be a lot of orders queuing there on the 40,000 point mark. So looking at the indicators of the Dow Jones Index, we can see that although there is a positive reading on the MACD indicator, last Friday there was a weakening of the momentum, although the trajectory of both the signal line and the MACD still have a sort of a little bit of a divergence after crossing the zero baseline somewhere during the middle part of June. But I think this is a very mild kind of a positive momentum reading. Hence, I would say that Dow Jones Index will also be in a range bound kind of situation. And if the range bound kind of situation were to develop in the next few weeks, then the earliest resistance level that we saw was on 24th of June, and that is at the high of around 39,571 points. And the support would usually be the 100 days moving average, which is the amber line that you see here, which has consistently been a good support for the Dow Jones Index, and that is around the level of 38,528 points. So to round it off, 38,500 points or the 39,500 points, that would be the 1,000 point range that we are looking at for the Dow Jones Index to trade in the next few weeks until a new catalyst develop, which could likely be found in the non-farm payroll data, should the data have any surprises that may be published. But according to the market estimates right now, everything should be still in line with consensus, and that would mean that the range bound kind of situation will continue unless we have any surprise on the macroeconomic data of the non-farm payroll numbers. Next, let's move to the broader index, the S&P 500. Of course, we have the year-to-date high at about 5,523 points, and now we are trading around 5,460 points right now as of last Friday close. You can see that when we are on a strong uptrend on the S&P 500, which greatly outperformed what the Dow Jones has done in the first half of this year, as per what Gerald shared earlier. The S&P 500 would usually take the support from the 20 days moving average, which is the basis of the Bollinger Band, the black line that you see here, as a support level. So if S&P drop below the 20 days moving average, that would be something of a alarm bell that you would need to look at the S&P 500, whether it's a good time to get back in on the S&P 500 index. Else, a safer option would be the 50 days moving average, which is now around the 5,310 points level. Indicators wise, you can see that the MACD indicator is in a very topish kind of a formation. The trajectory of the MACD line is coming downwards, now converging into the signal line, and that's why we have a negative reading last Friday, which means that the MACD might be going into a negative territory. meaning that there would be negative momentum developing for the S&P 500 index. The RSI index, you can see that in the middle part of June, we have already breached the 70-point mark, and that is where the index is considered overbought. And hence, from there, in the next 2 weeks towards the end of June, you can see that the RSI indicator has been coming down and is now reading at the 65 points level. So the last time that we saw such a scenario happening on the RSI index was somewhere over here on the 21st of March, where it hits close to 68 points. And earlier, you can see also in the January period where we hit a high of 74 points. And that is around the same area as what we saw on 18 June, the 76-point level. So once it hits below that level, you can see when I talk about 20 days moving average, that is where they could be using the 50 days RSI reading as a neutral zone for a support for the S&P 500 index. Else, if there's a larger pullback, the 50 days moving average would be the next level of support to look at for the S&P 500 index. And that is how I will read into the RSI indicator for the S&P 500 index. Next, let me go on to the tech-heavy Nasdaq Composite Index, which suffered the largest pullback on Friday, which is around 126 points or 0.71%. So we also have a strong indication that the 20 days moving average has been supporting the Nasdaq Composite very well in the first 2 quarters, first half of this year. And that support level, which is the black line that you see here, is now around the 17,457 points level right now. And on the indicator-wise, the MACD indicator is also showing some kind of a toppish formation, meaning that we could be seeing a change of direction, because once the MACD line crossed below the signal line, that is a signal that the direction of the index will be changing. And thereby, when we have a negative reading after a long while of uptrend, this may be a turning point for the Nasdaq Composite Index. At least for now, I think that probably the index can be a bit stretched right now. And a pullback around the 20 days moving average will get investor keen again to look at the Nasdaq Composite Index again. So similarly, on the RSI, similar to the S&P 500, we have reached the 70-point mark in the middle part of June. And that means that the RSI is coming back down right now, and it's deemed that at around the level of 17,750 points level, that is where the RSI hits the above the 70-point mark. And that is where it's deemed as a overbought level. And hence, we see a bit of stabilizing or a bit of a pullback on the Nasdaq Composite Index. So looking at previously where the index was trying to climb up, you can see that the RSI index, one is hits close to the 50-point neutral mark reading on the RSI indicator, the index will usually continue to trend up. Okay, so that is the key point that we are looking at. If let's say the uptrend momentum, you are of the view that uptrend momentum will still continue to climb, then a good point to accumulate would be around the 20-day moving average, and that is where the RSI should be close to the 50-point neutral mark. And for a safer entry position, that you can use the 50-day moving average, which is around the 16,970 points level. So to sum up some of the key support level, that would be the 17,000 handle that we are looking at, close to the 50-point moving average, and the high would be, of course, the year-to-date high, now at 18,035 points. So between the 17,000 mark and the 18,000 marks would be where the Nasdaq Composite Index will be likely trending in the next few weeks while we wait for more economic data or catalysts to develop. Hey, anything to add on, Gerald?
Okay, so I guess in summary, we have seen the equity markets having very strong performance in the first half of the year. Whether we look at the S&P 500 or the Nasdaq index, they have had significant gains. Going to the second half of the year, I guess the focus will continue to be on the Fed rate cuts and the economic data points that are coming out relating to inflation, the job market, will probably give us an indication of the Fed's next interest rate direction. We also have the US presidential elections coming up in the second half of this year. So that's another key event that investors will keep a very close lookout for, on top of the earnings that companies are going to start reporting from next week onwards. So with that, we will have the next weekly market review where we'll continue to update you on some of these key developments.
Yes, so second half looks promising after the positive first half of this year. And we will continue to update you with our weekly market review on Monday to keep you updated with what the market developments. And we'll continue to see you next Monday, same time, same place. And we wish everyone to have a safe trading week, and we'll see you again next week. Thank you, everyone, and have a good week ahead.
Thank you.